Talk to me a little bit about the yield curve. I've heard more about the yield, the 2-year and the 10-year. What are these exactly? Why do they matter? And why is an inversion something that investors should be concerned about?
Yeah, so I mean, the yield curve is as historically has been one of the best predictors of recession in the economy. And typically, what happens is you get an inversion in the yield curve, and that typically precedes. And what I mean by yield curve is the spread of the yield of the 10-year Treasury yield minus the yield on the 2-year Treasury yield. That inversion typically is a sort of longer lead time inversion. You typically wind up in recession somewhere between 12 and 24 months after that persistent inversion in the yield curve. There's also other yield curves. There's the 5s, 30s that tends to be kind of what's inflation expectations relative to terminal expectation on policy. There's the 10s, 3 month, 3 month bill yield, 10-year yield minus 3 month bill yield. When that goes inverted, you typically are in a recession or some very close to a recession. So there's all these different sort of term premiums across the treasury market that give investors kind of that send a signal, if you will, back to the Fed, back to the broader economy, that something might be very right, if they have a very steep, positively upward sloping yield curve and a bear steepener, or something could be very wrong if a bear flattener, or even worse, a bull flattener is telling you that there's some deflationary pressure. So investors like myself, economists, probably policymakers, we're all watching the slope and shape and changes in the yield curve as a signal from the bond market that, okay, XYZ is priced in, and then it's either changing at the margin or getting stronger.